When you're watching the news and hearing about the Dow is down 300 points and the S&P is up 600 points, you ask yourself, what's this all about? And why is the media always talking about the stock market? And how does this work? In today's video, we will be talking about the stock market, what it is and how it works. Welcome to Daily Update. If you're new on this channel and love finance and passive income, subscribe to the channel and hit the notification bell. Well, what is the stock market and how does it work? The stock market is a global network of exchange which consists of buyers and sellers of shares of companies. Let's say a company called Pear, which specializes in smartphones, has been operating privately for many years and has started becoming bigger and needs more money to expand and keep their operating going. In order to do that, they turn to private citizens. If a company wants to go public and raise more money for its business, in the United States, there are two places you can list a company to raise more money: the New York Stock Exchange or the Nasdaq. In India, we have the Bombay Stock Exchange and National Stock Exchange. In Europe, we have Euronext, which is the largest European stock exchange. In this video, we will be using the US Stock Exchange in our examples. So Pair.com filed for all the paperwork to go public, and we decided we would list our company on the New York Stock Exchange. Congrats! On July 1st, we went public and started trading our shares. This is also known as an IPO or Initial Public Offering. Pair decided to issue 200 shares at a price of $38 per share, valuing our company at $7,600. Share price is the highest amount someone is willing to pay and lowest amount it can be bought. Now, anyone who believes the company will be profitable will buy a share, and owning a stock or a share of the company makes them a partial owner in the company. The laws of demand and supply determines a price of a share. For example, pre-pandemic, airline share prices saw a record high in stock prices because the demand for air travel was skyrocketing, and analysts estimate a rise in air travel by the end of 2020. Shortly after the high estimate in air travel comes the global pandemic we are currently in. Government of nations started closing its borders and asking citizens to stay home. One of the heavy hit industry was the airline. People started cancelling their trips and staying home, and airlines started seeing a drop in revenue. Investors were not happy, started selling their shares. Anytime there's a big drop in sell-off, it increased the share supply of a company, and thereby decreasing the price of the share. Many factors can contribute to the rise and fall of a share price of a company, from as big as geopolitics to as little as drop in earnings. So let's say our company Pair start to outperform. It will see more buyers interested in the stock, which will increase the price of the share and the value of the stocks people already own. Investors buy and sell stocks based on what they believe the future price of the stock will be. Pair will then use the money it raised to expand its businesses by creating new products or research and development. But if for any number of reasons, Pair started missing its revenue and investors think the stock price of Pair will decline, they will sell their stock with the hope of making some money before the price of the stock drops. Now, higher stock prices doesn't always mean the company is meeting its earnings or generating more revenue for the product or service it provides. Amateur and professional investors will still invest in a company that believe it has future potentials, even if it's currently losing money. Great example is Tesla. Tesla is an EV company. It hasn't been profitable since its IPO, yet its stock price reached an all-time high of over $1,000 and a market cap of over $100 billion. Companies are worth billions of dollars on a piece of paper due to speculation. Let's look at the 2001 internet bubble. Many investors traded any tech company that ended with a .com, believing it has great potential in the future, even though they were currently losing money year over year. When this didn't happen, investors started selling their shares, and whenever there's a slight panic in the market, it creates a mass panic, which have many people selling all their shares, which caused the 2001 economic recession. Speculating in the market is what leads to daily fluctuation in share prices. It's a never-ending cycle. This makes a company appear more or less successful and the stock prices appearing to lose value. Since the stock market is often traded based on our emotions, that's why it's very hard to track or predict the outcome of a share price. That's why we always promoting reliable long-term investing over short-term. Investing in the stock market is tricky and complicated, especially picking the right company to invest in. That's why I recommend ETFs or exchange traded funds. ETFs are publicly traded on the stock market. it provides you with a bucket of diversified companies like Facebook, Google, or Microsoft. So you don't have to worry about investing in individual stocks. Example of an ETF you can begin with is the Vanguard S&P 500, which has the firm's broad diversification and low cost advantage far outweigh these minor disadvantages and outperform most of the ETFs out there. Investing in the stock market isn't meant only for the rich. Everyday investors like you and I can begin investing with a click of a button in the exact same way large investors would. There are so many tools and apps out there that will assist you in starting your investment career, like Robinhood, which has no fees to open a brokerage account. As you educate yourself on this complex system, you will be able to tell when a stock is overvalued or undervalued. That's when it's worth to actually buy or sell your shares. Note, all stock prices eventually falls. No matter how high it's getting right now, forward by speculation, it will eventually fall to its fair value. Don't follow the chart and buy when it's very high and sell low when the market starts panicking. Do the opposite. Now you understand how stocks are bought and traded. Leave a comment below to let me know which ETF or stock you would buy. Remember to hit the subscribe button and the bell beside it. Thanks for watching and see you in my next video.